The Federal Reserve is making big changes to its economic recovery plan in an effort to fight surging inflation, which has been a big deal, as you know. And today's announcement paves the way for a round of interest rate hikes next year. And joining us now is Jim Iuorio, economic analyst and director of TJM Institutional. Jim, thanks for putting this into context for us. So the Fed had just concluded a two-day meeting where they decided to scale back on purchasing bonds. That's what lays the foundation for the interest rate hike. When is that likely to happen, and how many times will they do it?
Okay, well, the market is telling us now that's between March and April of next year is when the interest rate hike comes. The Fed said that they think 3 interest rate hikes in 2022 and 3 in 2023. The market is not quite with them on that yet. A lot of times they've gotten things wrong in the past. Today, everyone's characterizing this maneuver today as the Fed pivoting to hawkish meaning tighter with the money supply. But realistically, it's the market believed that they were throwing gas on an inflationary fire before, and now they're throwing a little bit less gas on it. If they were really that concerned of inflation, clearly they'd tighten now and they'd stop their bond purchases. So the bond purchases are going to continue, meaning they're trying to still compress long-end rates, or at least not let them rise too quickly.
It's kind of like hedging their bets, I guess, right?
Amen, exactly.
So this is all because inflation has been so stubborn here. How soon do you think we would start to see the effects of bringing that rate down? It hasn't been this high in almost 40 years, right?
Well, 40 years ago, in 1980, was the last time we saw inflation readings like this. The 10-year yield was 12% at the time. Now 10-year yield is 1.45. Now, there's a lot of factors keeping the 10-year yield down besides the fact that the Fed is buying those bonds. I mean, around the world, they're buying those bonds as well, too, because sovereign debt around the world is very low. So I think if you're looking at things like mortgages, I don't anticipate mortgage rates going up considerably. The 10-year rates, which is what mortgages are based on, didn't move at all today. So again, this is something that was in the very, very distant future, and we've just moved it into the not so distant future. So I don't think anything's happening all that quickly.
Well, you just kind of led into my next question is, you know, beyond home loans, what else does this affect? And you're saying it may not affect it, at least not in the first round, much at all.
No, not much at all, because we're talking about little, minute, incremental things, and these are kind of test runs. When the Fed's going to, because there's been a lot of economic disruptions over the last 2 years, obviously, and when they talk about raising rates, they're talking about raising rates a little bit just to see how the economy is going to be able to handle that, and sadly to see how the equity markets are going to handle that as well, too. Now, the stock market today seemed to really like the news, because I think this, we think back to runaway inflation, and the last time we had Paul Volcker as a Fed chairman who was, raising interest rates quickly and not caring what the stock market did. The Fed cares what the stock market does, in my opinion, which I'm not sure they should.
When the pandemic winds down, whenever that's going to be, and there's evidence that it'll be with us in some form for a long time, but would that be a natural fix to this? Because the supply chain problems that we've been experiencing have been another big driver.
Okay, the supply chain issues are definitely a big driver, and as we wade through the pandemic, those will go away. But I think it's disingenuous to blame it all on supply chains, or even a huge amount of it, when we've increased the M2 money supply 40% just in the last 2 years alone, just since the onset of the pandemic. So Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon, meaning too much money chasing too few goods. I think the supply chain matters, but I don't think it matters as much as that.
You hinted at this a little bit, but do you think that this is the ultimate fix, or does the central bank, run the inherent risks by, raising the rates in terms of economic recovery?
So we always want this soft landing. And I think what the market saw today is that we don't have confidence that the Fed is going to engineer a soft landing. Not any disrespect to them. It's just a very difficult thing to do. But I think the market said today, if they're going to make a mistake, hopefully it's to the dovish side, easier money side, and hopefully it's not too much that way. Do I think inflation's going away anytime soon? No. And remember, too, when we talk about inflation going away, it doesn't mean prices go up and then come back down. It means the rate of increase slows and stops. I don't think these high prices that we're seeing now, except for the supply chain portion of it, are going away anytime soon.
Jim Iuorio, always good to see you. Thanks very much for your insight tonight. Appreciate it. Good to see you.